Hi, this is Jamie Bosse with Aspire Wealth Partners with a few tips to keep down markets in perspective as an investor. I don't have to tell you that this is a crazy time for investors. You already know that. As humans, we are wired for a fight or flight response when we sense danger. So your first reaction in this kind of market might be to take the money and run, to get out of the market altogether and stuff the cash under your mattress. Alternatively, your reaction might be to fight, to get aggressive and change your investment strategy completely. Today in this 4-minute video, I wanted to share with you some facts, history, and definitions to give you some perspective as you decide how you're going to react. This chart shows the hypothetical growth of $10,000 invested on January 1st, 1980 through January 1st, 2019. The first column shows what it would be worth by 2019 if it was left in the market the whole time. You can see that this resulted in a pretty significant gain. Think about all the terrible market events that happened during that time frame of 1980 to 2019. The first things that come to my mind are the dot-com bubble, the September 11th terrorist attacks, Brexit, quantitative easing, and the Great Recession of 2008-2009. If you go back into the archives further, there was a war in Iraq, the Chernobyl disaster, several bombings, the Gulf War, and the crash of 1987. All those terrible things happened during that time frame. But if you would have left that $10,000 invested in the S&P that entire time, that $10,000 would have grown to over $600,000 by January 1st, 2019. Now the next column shows the value of that $10,000 if the funds were taken out of the market and missed the 5 best days. 5 days over a whopping 39 years. As you can see, the total gain is much lower. Then you can see the further declines if the money was out of the market the 10 best days or the 30 best days during that time frame, and so on. So you can see that timing the market is actually really hard to do. And sometimes the best thing to do when it comes to your investments is nothing. I wanted to clarify some of the terms that are getting thrown around a lot right now. How do we define an actual bear market? It is a time of prolonged price declines when we're down 20% or more from the most recent high. If you remember back in 2019, way back in 2019, it was a fantastic year for the market. So we've definitely been down since those great highs. A correction, on the other hand, is a 10% to 19.99% decline from the high. Corrections are actually really common. There's usually about one a year. Once you realize that as an investor, you're less likely to react irrationally and will actually view those times as a buying opportunity. A recession is a term we hear daily. The technical definition of a recession is 2 down quarters in a row, so 6 months or more. Some more fun facts. Stocks lose 36% on average during a bear market. By contrast, they gain 112% on average during bull markets. Markets are positive the majority of the time. We just don't remember the good times as well as we remember the bad ones. Over a 50-year investment time horizon, you might see an average of 14 bear markets. Bear markets are pretty normal. They just don't feel good when you're in them. Oddly enough, a lot of market returns are actually made during bear markets. Half of the S&P's strongest days in the last 20 years happened during bear markets. Another 30% happened in the first 2 months of a bull market, so when it wasn't yet clear that we were actually in a recovery. Try not to let fear drive your investment strategy during this time. Focus on the facts and what you can control, and try to keep things in perspective. Thank you.